Alright guys, it is time for the market review. So today um, was a sort of eventful day. And the PA was okay though. I would say yeah, PA was okay. So here I'm looking at the hourly chart. As you guys know, there was an hourly bearish S&P divergence present at the time of the New York Open. So here's the divergence on the hourly, right about there. So here you can see ES never took the buy side, whereas Nasdaq took the buy side. So the hourly bearish S&P divergence was present, and then we have a couple more things to mention here. First off, the young range from this low. Why this low? Because it's an order block. Although it's not a divergence, it is an order block. From there, all the way to the high, you get the dealing range and range equilibrium, and then the objective of the bearish S&T is at least take out the short-term sell side, which is right about here. Okay. On ES, same deal, right about here, and the dealing range is from the OB to the S&T high. It has a different price action, but it's still there, right about here. So now that's done. Let's go down to 1 minute and short term. You know what? I'm gonna annotate this as hourly short-term sell side, which is the S&T divergence's main objective. So let's go down to 1. I'm gonna collapse ES here. Also, hold on 1 second. What I'm gonna do is I'm gonna annotate the sell side right here and the buy side as well. That's the range we're watching. This is the hourly range. So we are waiting for an hourly expansion towards buy side right now as a second leg. But that's another story. I'll be talking about it in a bit. So here, this is the hourly short-term sell sign. What you can do here on the 1 minute is basically you can anticipate a short-term dealing range, right, from the lows to highs right here. So the upper portion of the range is a short-term premium zone. Now, as you can see, at the time of New York Open, it was actually chopping around the range equilibrium, the short-term range equilibrium, but eventually it sold off, tagged the hourly short-term sell side, and it kept going lower a bit more. But here, let's take a look at what happened. So here, let me annotate. This is the premium fair value gap, and I believe that's the only premium fair value gap at the time of New York Open. Here, so that was a Judas swing. Right there, the premium fair value. As you can see, it's respecting the fair value gap from below. This is the CE of the fair value gap, staying below. The candles after it displaces lower, staying outside. Now here, it actually formed a trap, which I'm not going to annotate, but I'll show it. This is the trap fair value gap. It comes up and sells off. Now here, um, I don't think that was really like worth trading personally yet, because it's early in the day, the market was not in sync, etc. But let me see if it formed any 1 minute divergence. So let's go. Thursday right here, 9:30. Okay. Excuse me, guys. Sorry. Okay, so here I'm watching the highs. I'm looking at whether this formed a bearish divergence within that fair value gap at New York Open. Yep. So this is the divergence. It's not the kind I like, but it's what it is. It's a divergence at the end of the day. Doesn't matter if I like it or not. Right about there. So ES was making higher highs. Nasdaq was making, I'm sorry, vice versa actually. Nasdaq was making higher highs. ES was making lower highs. So the The S&T divergence, the trap is a short actually. And then this is another, this places below the range EQ one more time. This is the last premium fair value gap, still respecting that fair value gap, and then delivers the sell side. So that was the morning session, or New York Open rather. As it moves down, here I'm going to annotate both. ES also took the short-term sell side. As it moved down here, as you can see, I'm looking at the lows and the highs. It is not diverging at all. Here's the one divergence. This is probably the 5 minute though. One divergence. Now, because the divergence is there, it doesn't necessarily mean it's going to go for the buy side. Remember the market maker buy model, the market maker sell model, classes. The objective of the market maker models is two things. Okay, one, it's either gonna target the liquidity, right, whether buy side or sell side, or it'll target the fair value gaps or imbalances. Okay, now here the divergence occurred. There's a buy model. The market is a buy model, but that doesn't mean it's going to target the buy side, right? So it came up all the way down, all the way up here for a reason. I'll tell you why, and then went for the short-term sell side here. So let's dig in what happened there. Now, from S&T high to S&T low, you have a new short-term dealing range, right? So let's annotate that. Short-term dealing range. What do you see here? Once it trades above it, this is the only premium zone that it's spending time. Okay. Now here, it doesn't have to be a PDA, but there is one actually. This is the only fair value gap. This is the only premium fair value gap in the short-term dealing range or the short-term range. So it comes up there. The market maker buy model is complete. Also the divergence. This divergence is target for liquidity is at least the short-term buy side. Just here, it delivered. It did further damage into premium. Then it sold off, and in that price action, displacement right there. That's a short. Okay, this is a short. This is a short with a confirmation. This is an aggressive short if you short it here. So let me see if it diverged there as well. I don't see a divergence. Fair value gap, displacement, retest of the fair value gap, went for the short-term sell side. Now it completed its second leg basically. This is the one setup for life. Second leg is now completed. Um, the way you can anticipate a pullback is basically waiting for an opposite side of divergence because that means the low is set. Now it doesn't necessarily, once market forms a low here, even though it's a swing low, that doesn't mean that's the low. But once you have the divergence, the opposite divergence, now you have the swing low. Okay, this low is set, so it's now safe until the pullback is completed, or it is going to reverse basically, and in that case, it's going to rip through the range EQ and form a buy model from there on. In this case, it didn't happen. So this is the one setup for life. For me, it's harder to see the short or the sell side deliveries for the one setup for life because the market has been very bullish lately, and I'm having hard time spotting the sell side deliveries market maker sell models. So let me delete that. Here, no divergence, no divergence. It delivered though kind of beautifully, not gonna lie. Here, the fair value gap. And there's a reason why it comes down into this fair value gap. The reason is S&T low, pullback high. You see, that's the range EQ. If you miss this move, you can look at this because you know the target is going to be here. So you can imply that range as a very I don't know what it's called. I'm not going to call it short-term dealing range, but as a sniper entry, basically, you wait for it. Sometimes you're going to miss the entries, but more often than not, you're going to get that range EQ test. Okay, so if you have questions like why it's this fair value gap and why I didn't touch here, I was waiting for this one, that's why. Okay, that is why. There's always a reason. If you reverse engineer your price, you'll understand it better. So it goes for the sell side. This is a reversal pattern in the form of a V shape, sharp rejection. So there is a potential that the the market is reversing here and getting into a buy model because it's a V shape, and it formed a trap here as well. This is a trap fair value gap, and the accumulation here is a trap V shape, fair value gaps displacement. This is not a setup though. None of these fair value gaps, you should not be trading those or executing those in those fair value gaps, okay? Because this is a V shape, so here I call this time decay. Here's a time decay. It just decaying basically, doing nothing but damage. So you should be long in this fair value gap or this one or this one. Why? Because it is not forming a divergence. So if this was a divergence, for example, on the 1 minute here, yes, then that would have been a long. But it never diverged. Look at the lows. It's not a divergence. Sorry, it's not a divergence. This low, it's not a divergence. Okay, there's no divergence at all. And the rule for the V shapes is you're always going to have a divergence no matter what. Okay, so the V shape, another V shape here, and in that V shape, there's a fair value gap here, and the divergences will always going to be in the fair value gap on the V shapes. Here is the first divergence at the lows. This is a bullish divergence. Now you're in the buy model. Okay, not before, not after, but once it diverges like that, yeah. Once it diverges like that, this is the long. Okay, so you can long the breaker, you can long the order block, you can long the total soup on ES, whatever you want, or you can long this fair value gap as it diverges. Not before though. This is not an entry. This is not an entry. This is not an entry, but this and anything after is an entry. Okay? I hope that's loud and clear. So once it diverges like this after a V shape in a fair value gap, now I'm looking for potential targets for buy model. So let's see what do we have. So I'm looking at the highs, okay? Here, this is an original consolidation, so this is a potential target for the buy model. And if it displaces above it, uh, draw. This is a low-hanging fruit objective, basically. If it displaces above it, now we could be looking at other buy-side objectives because this is an S&T divergence. The likely draw liquidity for this buy model is this buy side, basically. Okay. But this is the low-hanging fruit objective. Let me put it this way. The high probability objective, basically. So here, divergence, market kind of like slowly grinded higher and higher. Um, but in that price action, there's something to mention. Here, no divergence, okay, at the highs. At the lows, no divergence. At the highs here, no divergence. It goes above now. Now there is a divergence right about here. This is not a 1 minute divergence. This is a 5 minute probably. As you can see, Nasdaq is making a higher high. ES didn't do it. ES left equal highs, and that is a divergence. Now, once it's there, you can anticipate. So if you miss this move, this is your entry. This is your entry opportunity. You literally have to let it go, let everything go in this price action before until it forms that SMT. Now, once it forms the SMT divergence at the high here, now you have your interest. Now you have to be in front of your charts, okay, in front of the monitors. You have a new dealing range, short-term dealing range. That SMT should do what? It should set price below into the short-term dealing range. It does immediately after it rejects and rallies. Now in here, you probably couldn't find an entry though, unless you know aggressively enter. Here, the first fair value gap retest is a long. It's a very late long though. And then let me just do this real quick. Boom! It completed the the buy model. So here, the first S&T divergence after the V shape is the first leg initiation. The bearish S&T divergence sets the high for the first leg. Now it means it's completed. Pull back. into first leg's range EQ. This is the one set up for life. Second leg is initiating, deliver the buy side. Okay. I don't know how I don't know if I could put it any easier than this. Now, that doesn't necessarily mean the market was easy to trade though. The 1 minute price action was a little choppy. I'm not gonna lie. It was a little choppy, but if you know the drawn liquidity, you shouldn't be concerned about any of the down close candles because those down close candles are there to secure your stop loss or your entry. Because if drawn liquidity is the buy side, all those down close candles are going to be respected. So even if, I mean, during live trading, it might give you some sort of anxiety, but think of this way. You got to trust the buy model, okay? You know the drawn liquidity and it's going to go there no matter what. This is the order block that shouldn't fail. As long as it stays above, you're good to go, okay? So then afterwards, it was basically choppy. Here there was another setup on the 1 minute basis that I want to mention right there. So it never formed a bearish S&T divergence at the highs. That means the second leg is not completed, even though it's displacing lower, but it's not completed. Now it formed a divergence here, which means this divergence should send the price right here. Okay, this could be a divergence as it moves higher, but it didn't do it, so it just kept the bullish order flow. Now going to tomorrow, here's what I'm looking at. It's very simple. I'm going to say one thing only. Because this is the second leg, on the 1 hour chart, I'm actually expecting the all-time high tomorrow, or at least it should try to go there, which is 691. So be mindful. Range EQ bounce. It could fail and go deeper, but as long as it stays bullish on the lower time frame, 691 is what we're looking at. That should be the drawn liquidity for this is the one set up for life for 1 hour chart, guys, 1 hour time frame. Okay, so that's it for today. I'll be uploading this video in a minute, along with the CPI live trading session and the FOMC live trading session, as I haven't uploaded them yesterday. It's coming today. So that's that. I'll talk to you guys tomorrow in the morning. I'll be live streaming the Friday. Hopefully we'll get it set up in the morning session. Until then, see you next time.